The next page shows some analysts' favorite in the valuation category, though it's far less known as a measure of value, and that's Tobin's Q ratio. And so I throw it in there because I've always found it to be a pretty good measure of underlying fundamental value. And the ratio compares the market value of all common stocks, of all companies, with the replacement cost of their assets. So it's a ratio of what's the market value relative to the replacement cost of the assets. And you can see where we are. We're not at the all-time highs. We're at 99. We're at 0.99. So we're, and the average over the long period of time for this whole century has been at 0.70. So we're not at the peaks. We're a little below most of these peaks, but we're well above, at 99, we're well above 70, and we're well above what has transpired in the lower regions. Let's turn our attention now from valuations to sentiment. The investment management industry is demonstrating, and we see this over on page 35, a very bullish outlook. This is a study of mutual funds, again, look at the bottom half of the graph. This is the amount of cash that mutual funds are holding as a percentage of their total portfolio. The latest reading is 3.4%. That is the lowest it's ever been. So there's confidence. We don't need cash. We aren't going to have a lot of redemptions. We've got our money invested. 3.4. And you can see, is that a good thing to have everybody optimistic like that? You can see up here in the performance box at the top, this is the least attractive category. When managers are most bullish, they have tended to get, and this is ironic, I suppose, they have tended to get their lowest returns. When there's lots of cash in the portfolios, they've tended to get their best returns. The next page shows the behavior of a more active segment of investment managers. This is a more recent study. It only goes back several years, just over 4 years, but it does confirm what the much longer studies show, and that the best results occur when the universe of money managers is most defensive, and vice versa. The worst occurs when they're most aggressive. And you can see right now they've gotten increasingly optimistic as this rally has continued. And again, you look up here and you see what has been the performance when they've been optimistic, and then what has been the performance when they've been pessimistic. And again, it's ironic. The rally since the July lows has moved the vast majority of stocks into favorable trends, which you see on page 37. We know that markets move in cycles. Long cycles, short cycles, and so on. Investors get overly optimistic, and then alternately they get overly pessimistic. And what we see now, and this is a percentage of the S&P stocks above their 50-day moving average. So it tends to mean that stocks have been rising pretty consistently, and they are now above the average price over their last 50 days. Well, you would think that's good. Stocks are in a favorable trend. But if you look at every time this has gotten to about the 90% level, it's been right about at or close to the peaks in these moves. Some of them are just small down moves that come after that. These are not necessarily beginnings or ends of bull and bear markets, but it does show that when optimism gets that high, you at least have to say, wait a minute, maybe everybody who wants to own stocks does own stocks. Maybe the buying power has dried up. And we see the opposite sentiment over on the next page. Nobody loves the dollar. And you can understand why, too, with QE2 on the horizon and are doing nothing with low interest rates to try to attract people to own dollars. But this, again, is an interesting study in sentiment. If you look over to where the dollar is now, and it closed just above 77 today, so just a tick down from what you see on this graph. Right now, if you look all the way down to the bottom, 3% of the investors in this study of dollar buyers, dollar sellers, 3% are bullish or optimistic on the dollar. 3%. This is a low that was about a 16% decline in the dollar over a 10-month period. That bottomed with 7%. When this decline ended, it bottomed with 7% bullish. This time, it's gone even further down. Now there are only 3% bullish. And I don't know if that's a near-term bottom or not, but certainly there aren't too many more sellers out there available if there are only 3% bullish. So it is at least a high sign that maybe things are going to go a bit in the other direction. And we see the opposite picture on the next page in the euro. They've tended to move just about opposite one another. After a very big gain for 10 months over here, you had 93% bullish just before the euro collapsed. And now we have 97% bullish right here after the euro has been moving very strongly to the upside. And we see the same bullish excitement in the precious metals over on the next couple pages. Everybody loves gold. These are, well, I won't get into the makeup of them. You've got 95% bulls, 98% bulls here at this current level, and it was up very strongly again today. Gold was extremely strong today. And we had 98% bulls right here. Interestingly enough, you would hope that you had, I don't have the exact number down here, but there was not a large sentiment of bullish investors at that low point. So it's at least a short-term caution. It certainly doesn't have to mark a meaningful top in any way. It's just that when everybody gets really bullish, at least on a short-term basis, be a little bit careful. It's completely understandable why investors hold a bullish view on gold. Gold's price is up about 100% just over the past year. And central banks, of course, around the world are threatening to go on a money printing spree. And nobody wants a strong currency, which I mentioned before, which, of course, damages their export potential. But we've long urged people to hold some gold, not necessarily in their investment portfolios. I almost think about it as an insurance policy. We bought gold back in the mid-1980s, and we've never thought of it as an investment. It's more just something we got. And there's an old saying, you should always have enough gold to bribe the border guards. And, perhaps born in a different time and a different age, but there's some common sense to that when monetary policies are going somewhat awry. And people can speculate in it if they choose. At this point, because of the tremendous bullishness and the tremendous run-up it's had, a meaningful correction could certainly occur at any time, even if it's fated to go considerably higher at some point in the future. And if you look at the next page, you see the same picture in silver. We've got 97% bulls, whereas down here, just before this great rally began, 12% bulls. You'd rather be bullish at the bottom, not at the top. Now, I don't know that this is the top in silver. It's just a caution. And there's been a great deal of favorable publicity recently about the economic progress in the emerging markets. China, India, Brazil, Russia. Those are the most commonly profiled. And there's no question but that the prospects for many emerging countries are excellent, but that's not new. I mean, they didn't suddenly just become excellent. They have been excellent. The prospects have been excellent for some years. Page 4.